Hey everyone, hope you're doing well. My name is Drew Creekmer, and I'm the Director of Advisory Services here at Creekmer Wealth. And in today's 5 Minute Finances, I want to talk about stock market volatility and retirement. And I actually want to walk through both the pros and the cons of volatility in our investment portfolios as it relates to our retirement income plan. And so often, what I see is that people are really concerned whenever the market starts to get a little bit volatile. We saw that earlier this year in 2026. We saw it in the early spring of 2025. And the reason a lot of people get concerned is that volatility, especially when the market's moving down, a lot of people really feel uncomfortable that that's going to impact their ability to live the lifestyle they desire in retirement. Now, volatility is not a bad thing. Well, let's define what volatility is. Volatility is simply the measure of the upward or downward movement of a stock market, of a stock, of a commodity or a bond. It tells us how much will stock A go up relative to stock B. And volatility at the end of the day, yes, is concerning the downside, but at the same time, when the markets are moving up, people love having more volatility in their portfolio. They love that because they're making more money. The more volatility potential you have, the more upside potential you have in your portfolio. That's also true to the downside, though, right? More upside potential, more volatility to the upside, more volatility to the downside. And so a lot of people get really concerned about that. Now, here's what I so often see. Volatility is not the bad thing that we need to be concerned about. What we need to be concerned about is an unplanned retirement income plan. And here's why that's so important. If you know, number one, exactly how much you need to spend to live the lifestyle you desire, and number two, you know how much guaranteed income you have in retirement, well, then number three, you know how much money needs to come out of your investment portfolio, and then you can invest based upon that need. And so here's a good example, right? I have a client who's blessed to have Social Security and a pension, and those two income sources by themselves more than meet the needs that they have to live the lifestyle they desire. And so what that means for their investment portfolio is that we don't need those assets for income. Sure, if they're going to take a big trip with the family, they may take some assets out and use that to fund that trip. But for the most part, those dollars are going to ultimately either be used for their future care many decades down the road or pass to their beneficiaries. And so we actually have their investment portfolio very aggressively invested for someone who's just now in retirement. And you know what? That's totally fine because their guaranteed income sources have totally met their needs. Whereas if we have a different client who really just has Social Security and their spending needs are actually 60% more than their Social Security, well, we need to have a different approach to the investment portfolio. We need less volatility because if the market's down 10%, we don't want to be down 10% and pulling money out, which is a double negative, right? And so we need to take a different approach to investing. And that's why I say the most critical element when it comes to designing a strong portfolio in retirement is a clearly defined retirement income plan. Now, once you know what that gap is that you need to fund with your portfolio, you're able to go back and then adjust how you're going to allocate your assets in retirement. And what I so often see is that lack of deep thinking on the income side impacts the portfolio decisions. The other thing I see is that a lot of people just kind of get lulled into complacency. The last 15 years has been one of the best bull markets in the history of the United States. And even though we're maybe approaching a few years from retirement or a few years into retirement, I see a lot of folks who are really overly aggressive in how they're currently allocated. Now, there's a couple of reasons for that. Number one being the last 15 years has been massively beneficial for anyone that's been invested in the US stock market. But because it's been beneficial, I see a lot of folks have a much larger percentage of their investment portfolio invested in stocks than what they historically should based upon their stage of life. Now, that's a good thing, but we also need to recognize that things change and what goes up must eventually come down. Now, I'm a glass half full type of person, and I personally love investing in the US stock market. It's been one of the best wealth generators in the history of humankind. But we also need to recognize that there can be a decade like 2000 to 2010, which Time Magazine referred to as the lost decade, because in that decade, both the Dow Jones, the S&P 500, and the NASDAQ index for inflation didn't earn any money. The Dow Jones was up about 2.25% in that decade. The S&P was effectively flat, and the NASDAQ was negative. And that was in the early 2000s. That wasn't that long ago. And if you go back over time and actually study history, you will see every 15, 20 years, there's a rough decade for the US stock market. So don't get complacent. And also, make sure you do a risk assessment. Make sure you actually understand how much potential for loss and gain do you have in your portfolio. Take the time to actually discover the data and dig in more. And so, if I was going to encourage you to do anything at all, number one, make sure you have a clearly defined retirement income plan. And number two, make sure you have a good risk assessment done on your portfolio. And if you've never done a risk assessment, let us know. Shoot us an email, give us a call. I can have one of our investment analysts run it for you in about 5 minutes. And it will tell you down to the dollar how much you stand to lose if we live through another, let's just say 2025 market correction or a 2020 or a 2008, and actually tell you what does that downside potential look like. And then you can take that and determine based on your income needs, do you have enough volatility? Do you have too much? Do you need some more? And that will actually help you and make a wise, informed decision on your investment portfolio. So thanks for the time, y'all. Hope you have something new to think about. We'll talk to you guys soon.